Welcome back to Trade and Wait, where we're going to review price action on the ES chart utilizing ICT concepts for today. I'm trying to get the video started before the 1800 hour opening of the futures market, just to see what price does. Right now we are trading above Friday's high. Let's see what happens there. All right, so someone asked me why do I sound so dry when I'm giving these talks? And I don't know, honestly. I just think like this is my normal voice. Well, it's actually much deeper than this, but anyway, still my normal voice. But honestly, trading, you need to learn how to be calm while you trade. It's not like you can trade for entertainment. I can make these videos to entertain you, but this is review for those who need to review. Like, you got a different model, different trading style, then that's even better, right? We can actually learn from each other. But this ain't, I'm not doing this for no, I'm only doing this because I enjoy it, I'm not doing it to entertain necessarily, This is for those of us that enjoy price action, that enjoy the markets, and that see a way out through the market, right? In any way that is, right? Rather that's coaching people, rather that's trading yourself, or whatever the case is. Rather you doing combines, or you trading a small account or a large account. Like, I don't even care. Like, you know what I mean? Do you, Anyway, this chart looks really nice, and sometimes I get caught up in the 5-minute charts. I do know some people only trade the 5-minute charts. They don't come off of it, and that's fine. That's good for them, But for me, I notice that when I don't follow the rules, and at a very bare minimum, high time frame chart needs to be analyzed. High time frame chart needs to be analyzed prior to engaging price. That's how I feel. All right, so internal range, external range, then you're climbing up, taking out more external range. So you gotta, it's not necessarily 3 drives, but 1, 2, 3. You gotta pull back into a discount, into internal range again, then external range. Is that clear? It's very clear to me. And one thing you can also do is draw out this down close candle, the high here in this case, as your order block. I'm still under the weather, so please pardon me. My voice may go in and out. I may mute the mic and cough or whatever the case is, but whatever. I'm still gonna still have to stay committed to my agreements, and this is one of them. So you want to highlight this as well. The void. What else we got? All right, that's the ES 4-hour. Sorry, I think, and this is just generally where I go. I explained this in the previous videos why. Use a 4-hour. 4 hours not clear. We go to the 1 hour, and then we're gonna look for market structure or price action models to engage price in, aka where we find edge at, where we find trading opportunities. And actually, I like the quote from ICT. That's what I'm referencing. But a 4-hour chart, you remember the screenshot, of the 4-hour or short-term trading is 4 hour, 1 hour, 15 minute. The 1 hour is, or day trading is 1 hour, 15 minute, and 5 minutes as a short-term time frame, or your trading time frame. So I'm saying that to say this, in general, the 4-hour chart goes with the 15-minute chart, but it can also go with the 5-minute, doesn't. But you may more readily see setups on the 15 minutes, and then if that's not clear, then you can move on to your to the 5-minute chart. But that sounds like a trap, right? Don't just if it's not for you, just leave it alone. It's one of those. All right, so that's that order block here. This is the 4-hour fair value gap here. This is the liquidity void here, or volume imbalance, whatever you want to call it. External range liquidity, which is Friday's high or the or last week's high. Yeah. Let's make that times 2. And yeah, so this is discount the premium. I'm just gonna highlight that, right? So this is below 50%. It's 75%. So there you have it right here. Right, so that's below. This is the range low, range high, retracement into discount below 50%, into an imbalance, internal range liquidity, then target and external range liquidity. Don't need to go down here, but we will. All right, so that's a solid retracement. I'm gonna keep it pushing. I'm looking for my darling. Oh, my darling. I'm looking for my darling, which is market maker buy and sell models. So pretty clear on this time frame here. We're gonna get rid of, we already know that this is the optimal trade entry long. And utilizing the principles, high probability that Asia, or the London session would be a Judas swing, 2, that it would create the low or the high of the day. So we have that. Then I told you guys that I keep the Asia highs and lows on the chart throughout the range, right? So we have the London session rating the Asia lows, and then targeting the Asia high, and obviously these highs, and then these highs. So this is a 15-minute buy model. Honestly, when the charts is like this, it looks cute, but it doesn't do it like until like this. Like, hold on, like this tells me, for me, this compacts it and this makes it much more like readable. You can see now accumulation, manipulation, distribution, right? Then you have all of this. Then you have a steeper pullback, and then the rally higher, right? So all of that's like, and it never broke this low, right? Because this was the fake move down, or the model, accumulation, manipulation. All of this is distribution, even though accumulated here. You can say money reversal, bled out here, traded right back down into the original consolidation. Well, in this case, what we're speaking of, right? Traded back down into the consolidation here. And I just pointed out, right? Maybe thinking about AMD, right? Accumulation, manipulation, distribution. Then you got a retracement back into the accumulation phase, and then a push higher above the previous swing high. That's a story. That's a story. I like it. I think that story says a lot. All right, let's get rid of the. See, that's like overall, like utilizing the previous session highs and lows, retracement into that. That gives you an opportunity. So we have one setup mapped out. Didn't really, and that's the optimal trade entry utilizing this swing low to this swing high. So that's one entry model. And we have here trade into this 4-hour bullish fair value gap. And we're going to see, so they have right in sell side, dropping down into this accumulation. All right, so boom, drops down below into that 4-hour order block. You have that here. And that's good. That's what you'd like to use. Otherwise, it's irrelevant. Just ignore it. I'm not even going to reference that going forward. But anyway, drop down below the 4-hour fair value gap. All right, which means, so if it held below, this would be an inverted fair value gap, which will support us, which will support prices going lower, right? So we have that. We have this run up to consequent crouching, almost, or maybe literally, who knows? Not going to stress that out, but you see that pullback. Do have a break in market structure here. It's significant because of this gap here, this bearish fair value gap that was violated. So you have that trading into this order block on the 15-minute time frame. So you have that. If you do trade order blocks, otherwise you're just gonna stick to this inverted fair value gap here. Right? Golden. And that's optimal trade entry. This is still your London session, or right after. Here is just before 9:30. And I was watching this. I'm like, oh, manipulation phase is happening before the market opens. And I was wondering, will price pull back lower? But see this bullish fair value gap here. And we right around consequent encroachment of the 4-hour fair value gap. And you can see here that the bodies are respecting the consequent encroachment of this 15-minute fair value gap. And here, price respected the bodies respected the low of this inverted fair value gap. All right, so this is your turtle soup smart money reversal. Not worried about that. Here's your low risk buy right here, and here's another one here. And on top of that, we have optimal trade entries just running wild, right? Anyway, you can see where this 100% is. That's the low, swing low to this swing high on the 530 candle. Then you have a retracement down into the order block or into this inverted fair value gap for optimal trade entry, and everything is holding above the 61.8 level. If you wanted to, you can actually have gotten in a lower, the steeper discount. That's great. And in this case, if you took this entry and you held it, this would be 4. Right now we have 4 standard deviations up here. Let's see, we could extend it to, let's see what 5 looks like. That's really like 5. So we got a nice 5 standard deviation run higher above these highs, previous week's highs. That was a very, very good run and an excellent risk to reward. This is all your risk. Your risk was, let's see, your risk was actually, let's say 61.8 literally at the low of the 4-hour fair value gap. All right. And your stop loss would have been here at this swing low, the London low. And let's say you were only targeting this swing high, the London high. That's almost 4.5 risk to reward ratio. Because this is all you're risking here. How many points is that? They got a 5.75, 5 points, almost 6 point stop loss. Or in this case, this would be about 25 pips. So you risk almost 6 points to make 25 points, which is almost in alignment with one standard deviation. Or let's say you were targeting the Asia high. Let's just round down in this case. 7 risk to reward, 7 to 1 risk to reward. Your stop loss, your risk to reward didn't change because this is where your stop is. This is still where your enter is. Doesn't matter where you plan on exiting. And this is 43 points. Or you can just be modest and just exit at the 2 standard deviations, which would be almost still 7 to 1 risk to reward. But let's go target in the previous week's high. That was excellent. Almost 14 to 1 for almost 80 points. Based on your entry to stop loss and your target. That was a good run. But anyway, I did that to emphasize the importance of doing the math of this, right? So, all right, let's say you missed that because not everybody traded the London session or immediately after the London kill zone, right? So whatever. So you still had this, because this is also a break-in structure. Now, break here and a break here and a pullback. Still 61.8. Still 2 standard deviations. Risk to reward in this situation, 61.8 is still, you could have gotten away with putting it here, your stop loss here. And in that case, you got 70.5, and you have almost 3 standard deviations for your exit. In this case, 2.5. And that's pretty solid. So your entry will be 59.0450, and your stop loss will be 58.9550. And that's about about 10 points. I don't want to break out the calculator. This is naturally, I set it for 1-to-1, but let's adjust it. So let's use 61.8 as our entry model. This is your stop. Approximately 10 points, 9.25. And 2 standard deviations will get you to right here. And you have about 74 points for 10 point run. 10 point stop loss, right? So your percent R, your R is literally this is what you risk, and this is multiples of R right here, almost 7 of them. And if you held it to the previous week's high, almost 8 of them based on your entry to stop loss. So this is all you're risking, right? However many contracts, however big a portion size of your account you're risking per trade, this is it. And that's your opportunity. That's nice. That's nice. And this is a 15-minute chart. And you have very little. This is like acceptable risk right here, because it's a 15-minute chart. It's not a 1 minute. Like 1 minute with a 10 point stop loss is like, I mean, it's all good. It's all good if that's for you. But all right, so boom, right? We got one setup, not including the turtle soup. Got one setup here, two setups. You don't have to use optimal trade entry. You could just use the fair value gap, inverted fair value gap here, bullish fair value gap here, and price test shot. We have that volume imbalance here. It actually shows on the 15-minute chart as well here. And you can see price just push through it, use it as support. So consolidated here. So you could have done one of two things, because it's consolidating after a strong bull run, right? Meaning these 1, 2, 3, 4 candles. It's an hour, and then consolidate it. Could have exited most of your position and held on, because you don't see another setup here, right? This is a continuation pattern though, because it used this as support, right? Or the breaker here. Right? You want to use the candle high, or you want to use the body. Looks good. Right? So that's two setups plus a continuation pattern. I think that's it, man. I don't think we need to force anything else, because price is just that. This whole thing is just like beautiful though. But this is a market maker buy model. Let's see what the 5-minute holds, if anything becomes clearer. But you can also do power of 3 for the day, right? Here's your midnight open. And for longs, you're looking to buy when prices below the midnight open, and you're looking to sell when prices above the midnight open, because you were bullish, right? So you got in somewhere below the midnight open, which is a discount in this case, regardless. So the ideal place to get in was, obviously, I'm gonna say it again, below the midnight open. And this offers pretty much the same setup on a 15-minute. Yeah, pretty much the same setup. Now here on a 5-minute, you have a opportunity to join in on the, for me, very easily see an opportunity to continue higher as price holding above this 5-minute fair value gap. So after it broke this level. So tracement and a push higher. Yeah. So I like it. And targeting the previous week's high, like we already pointed out. That's all I got. Thanks for listening. Oh, it's after 6. So what's happening here? It's just consolidating above the previous week's high. That's great. Anyway, after it took out the previous week's high, consolidating above it, after it showed the willingness to trade below it. Let's see. No real a break. Yeah. All right, cool. Oh, nice talking to you. Nice talking to you. Thanks for tuning in. Please like, comment, subscribe. Peace.